I'm Matt Stout, your mortgage navigator. Higher mortgage rates mean higher monthly payments. This can make it hard to keep your head above water.
Going under. Hold your breath. Uh-oh.
Fortunately, there's options that can help. 2-1 Buydown is a popular mortgage program that lowers your payments for the first 1 to 2 years. While this is not the best option for everybody, here's 3 pros and 3 cons to consider. Pro number 1, a 2-1 Buydown lowers your payments. Here's how it works. The seller agrees to pay a fee to temporarily lower your interest rate 2% for the first year and 1% for the second year. On a $450,000 home, this temporary buydown would lower your payment by about $500 a month for the first year. The second year, the payment would go up about $250. Finally, the third year, your payment goes up to back what it would have been if you had not done the buydown at all. Con number 1, buydown fees are the same as your total payment savings. In our example, the overall payment savings came to $8,000. The lender's buydown fee is also $8,000. So if the seller was only willing to pay your buydown fee and not any additional costs or price reductions, you could have just put the $8,000 towards your normal closing costs, resulting in $8,000 less that you'd need to bring to closing, which means you'd have $8,000 more in your bank account at closing. Pro number 2, the same home you're buying now may have been more money last year as there were too many buyers and not enough houses to buy. Now you're able to find a home and get a better deal because interest rates are higher, as many buyers have decided to wait for interest rates to go back down. If you wait for rates to go back down, you may not be able to get a good deal again because guess what? There'll be more buyers on the market again. Interest rates are likely to go back down at some point, and you can just refinance to a lower interest rate when they do. If you're able to refinance in the buydown period, your lender will refund any unused buydown fee that paid to get you a lower interest rate. Con number 2, if interest rates do not go back down, you'll be forced to pay higher payments longer than you expected. Pro number 3, a 2-1 buydown is useful when you know your income is likely to increase over time. For example, you just graduated from college and landed an entry-level position in the career of your choice. You know you'll have the opportunity to make more money in a few years, but for now you're just paying your dues. A buydown may allow you to get a better budget and future payments towards your future income. Con number 3, you may not be able to afford a higher payment later. If something happens to your game plan, you may not be able to afford the payments when they do go up. Bottom line, a 2-1 buydown is a great tool to get your budget in line and help you manage your payments, especially if you're able to negotiate a better price on the home you're buying. That said, if you can't afford the payment without a buydown, you shouldn't consider buying it with just a 2-1 buydown so it's more manageable. You probably should just buy a less expensive home or make some lifestyle changes so that you have more money to budget for an investment in a home. Check out icansavemoney.com to find your best mortgage options, or just give me a call at 800-340-5465 to take the next step. Be sure to like this video and subscribe to my channel for more helpful mortgage information. And feel free to send me your mortgage questions, or just more than that, remember to make this moment a great one.